Okay, so in chapter 10, the focus is long-term financing, and for all intents and purposes, we're going to focus on bonds throughout this chapter. All right, so we want to think of um, business financing, primarily corporate business financing, comes from two sources: bonds, which we'll address in this chapter, and then chapter 11, which is stocks and equities, which we'll address in the next chapter. All right. So when you think of a bond, you want to think of it essentially as a loan, typically a long-term loan made to a company, right? So investors with money to invest will essentially make a loan to a company that will use that money, invest in its business for a period of time. And what the investors get is they get interest payments, generally semi-annual, which means twice a year. All right, so that'll be important when we think about how we want to use the tables, because we're coming back to the tables when we work problems. So we'll do that momentarily. But the investors are going to get semi-annual interest payments, typically. So that means twice a year, based on the amount they invested. And then at the maturity date, which is the date that the corporation pays back the principal that the investors lent the company. All right. Interest computations are back, so we'll see some of those. We'll work with those again. So let's talk about, so you have some companies that rely heavily on bond financing, and we want to think of it as a substitute for equity financing, which is sale of stock. All right, so you can issue bonds, and if you issue bonds, bondholders don't get to vote in company governance, so bonds do not affect control. If I own 20% of the outstanding shares of stock, I may not want more stock to be sold, but I may be okay with bonds being sold, right? And when you invest in a bond, or I should say when a company pays interest on a bond, they get a deduction for that interest. It's an expense, right? Whereas when companies pay dividends to their shareholders, those are not deductible, all right? The biggest disadvantage is the cash flow. You have to have cash on hand to pay back the bonds semi-annually. Most bonds are semi-annual, which means they pay interest twice a year. And then also at maturity, which means if you have a 10-year bond for $10,000, the company has to have $10,000 on hand to pay that bond off at the maturity date in the future. It is very common practice to retire a bond issue with the next bond issue. So sometimes companies will, and they're even called serial bonds. So sometimes they'll retire bonds with the next bond issuance and just keep that going in perpetuity. That's not uncommon. But they do require cash flow planning because the investors have to get paid semi-annually interest, which is twice a year, and also they get their money back at the maturity date, which is whatever the term would have been. Okay, so here we have, this is just information you might find either in a financial newspaper or on a website about bond securities. All right, and so some information here. This is obviously bonds for IBM. All right, that's a company. The rate. And so if we were to go look at the bond or read the bond contract, bond indenture, we would find a interest rate of 4% in that document. All right. Maturity, this is typically in months. So these bonds would have 42 months to maturity. And they're sold to yield 3.81%. All right. So the way bonds work is there's always a contract rate, but then there's a market rate, and this yield is the market rate. All right. Volume we don't have to worry about. Close. This is a price. All right. And so you want to think of this as a percentage. All right. So if you were to buy $1,000 in, well, let's keep it real simple. If you were to buy $100 in IBM bonds, you would pay $103.08. Now, why would you pay $103.08 for a $100 bond? Well, because that bond is going to pay interest at the rate of 4%, which is higher than the market yield, the market rate of interest of 3.81. So over the next 42 months, the additional $3.08 equalizes the yield to 3.81%, or the market rate of return, right? And so that's what that is. The change we won't need to know, but that really is a measure of the change from the previous reporting period. In most cases, that's a 24-hour period. All right. This is a bond. Obviously, it's a copy. You cannot read it very well. But this is a bond issued by the Minnesota Vikings. I think it was issued for stadium expansion. It is not uncommon to issue bonds for infrastructure. Stadiums, governments will issue bonds for a new city hall, or new roads, or things that are going to be kind of long lasting. All right. Universities will issue bonds for new dorms quite often. All right. If you could read this, it would give you an interest rate and a contract term. All right. So let's talk some terminology. Bond discount or premium. So when bonds are sold, one of three things can happen. And we'll talk about the most unlikely thing to happen. That is, a bond sells where the contract rate, in the previous instance, that 4%, equals the market rate. Right? In the previous example, the previous slide, that was 3.81. Right? When those two rates are equal, the bond will sell for the face amount. Right? In the example I previously stated, that would have been $100. All right? That doesn't happen that often because rates fluctuate. All right. Now, and you might say, why not just have the contract rate always equal the market rate? The contract rate doesn't float. So if I issue 10-year bonds, they have to have an interest rate. That's the contract rate. And that is fixed. It doesn't change. Right? So I just have to pick a number. Now, the market rate is going to fluctuate from day to day or from week to week. And so that governs, that dictates what price bonds actually sell for. So, in the next scenario, contract rate is greater than the market rate. Well, we saw that with our IBM bonds. The contract rate was 4%, market rate was 3.81. All right. Bonds sell at a premium, more than face value. Right. In this case, 103.81% was the premium, or the 3.81 would be the additional premium. The other thing that can happen is the contract rate can be less than the market rate. If this is the case, in order to entice customers to still buy the bond will be discounted. All right, it's going to sell for less than the face amount, right? And so again, these are usually expressed as a percentage. So a bond selling for 97 would be selling for a 3% discount. All right. This is in the abstract, so we're going to work problems to kind of bring some concrete or some structure to this.